There's a story I've told before about my 2 rules of investing. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. People usually laugh when they hear it because it sounds simple, maybe even simplistic. But most people completely misunderstand what I mean. And that misunderstanding costs them a fortune over their investing lives. When I say never lose money, I'm not talking about avoiding every temporary decline in your portfolio. If that's your goal, you'll keep everything in cash and inflation will destroy you. I'm talking about avoiding permanent losses of capital, the kind of losses you can't recover from, the kind that set you back years or decades. And the method for avoiding those losses isn't complicated, but it requires discipline that most people don't have. Let me start by explaining what causes permanent losses, because if you understand the causes, you can avoid them. The first and most common cause is paying too much for something. If you buy an asset for significantly more than it's worth, and that excess valuation gets corrected, you've suffered a permanent loss. The asset isn't going back to that inflated price because it was never worth that much to begin with. You overpaid, and the market eventually made you face that reality. This happened spectacularly during the late 1990s with internet stocks. Companies with no earnings, sometimes barely any revenue, were trading at valuations that assumed they'd dominate the world for decades. People bought these stocks not because they understood the businesses or because the prices made sense, but because the prices were going up and they didn't want to miss out. When reality set in, and most of these companies turned out to be worth far less than the market had valued them, the losses were catastrophic. Some went to zero, others lost 90% or more of their value, and many never recovered to their peak prices because those peaks were delusional. If you bought near the top, you suffered a permanent loss, not because the market was irrational, though it was during the bubble, but because you paid a price that had no relationship to underlying value. You violated the first rule, and you paid the price for it. The way to avoid this is simple in concept but hard in practice. Don't buy things when they're overvalued. Only buy when the price is reasonable relative to what you're getting. But how do you know what something is worth? That's the harder question. For individual stocks, it requires analysis. You need to understand the business, the industry, the competitive dynamics, the management quality, the financial position. You need to estimate future cash flows and discount them back to present value. You need to build in a margin for error because your estimates will be wrong. This is difficult work, and most people either can't do it or aren't willing to put in the time. That's why, for most people, the answer is to not try. Just buy the market through an index fund. When you own 500 companies, some will be overvalued and some will be undervalued, but on average, you're paying roughly fair value for a diversified collection of businesses. You're not going to suffer the permanent losses that come from overpaying for a handful of individual stocks. But let's say you do want to invest in individual stocks. The discipline you need is patience. You wait for opportunities where the price is clearly below what you think the business is worth. You don't buy just because you have cash sitting around. You wait for pitches you can hit. Most people can't do this. They feel like they need to be invested at all times, like having cash is somehow failing. So they buy mediocre businesses at full prices just to put money to work. And then they're surprised when those investments don't work out. I knew someone who put about $80,000 into tech stocks in 1999 and early 2000. He didn't understand the businesses. He just knew the stocks were going up and everyone was getting rich. By 2002, that $80,000 was worth about $15,000. He held on, hoping for a recovery, but those specific companies never came back. He lost $65,000 permanently because he paid prices that made no sense. That's not bad luck. That's violating the first rule. If you don't understand what you're buying, if you can't estimate what it's worth, if you're buying just because the price is going up, you're setting yourself up for permanent losses. The second cause of permanent losses is fees and expenses. This one is quieter than overpaying for assets, but it's just as damaging. If you're paying 2% per year in investment fees, that's 2% of your capital disappearing every year, gone forever. Over decades, that compounds into an enormous drag on your wealth. Let me show you the math. Start with $100,000, invest it for 30 years at 8% annual return with no fees. You end up with about $1,006,000. At 8% with 2% in fees, so 6% net, you end up with $574,000. You lost $432,000 to fees. That's not a rounding error. That's the difference between a comfortable retirement and a struggling one. And what did you get for those fees? In most cases, nothing. Most actively managed funds don't beat their index benchmarks over long periods. You paid extra for the privilege of underperforming. That's insane. But millions of people do it because they don't understand the cumulative impact of fees or because they think their fund manager is special. The method to avoid this is straightforward. Use low-cost index funds, pay 0.03% or 0.05% instead of 1 or 2%. On a $100,000 investment, that's the difference between paying $30 a year and $2,000 a year. Over a career, that difference is hundreds of thousands of dollars in your pocket instead of someone else's. This also applies to financial advisors. If someone is taking 1% of your assets every year, they need to be adding more than 1% of value. Most can't. They might help with financial planning or with keeping you disciplined during downturns, which has value. But 1% per year in perpetuity is a very high price. Make sure you're getting your money's worth. I've seen people pay these fees for decades without ever questioning them. They get statements showing their balance. They see it growing slowly, and they don't realize how much they're giving away. If you have $500,000 in an account and you're paying 1%, that's $5,000 per year. Over 20 years, that's $100,000 in fees alone, not counting the compounding you lost on that money. That $100,000 could have grown to $200,000 or more if it had stayed in your account. People get upset about paying $50 for something unnecessary, but they'll hand over $5,000 a year in fees without thinking about it because they don't see it. The money just disappears from their returns before they notice. This is how the financial industry makes billions while providing questionable value. The third cause of permanent losses is panic selling. This is where you turn temporary declines into permanent losses through your own behavior. The market drops 30%. You can't stand watching your account shrink. So you sell everything. Then you sit in cash while the market recovers, too scared to get back in until it feels safe, which is usually after most of the recovery has happened. You've locked in the loss and missed the rebound. This happens in every bear market. People who had perfectly good investment strategies abandon them at the worst possible time. They sell low, they buy high later, and they destroy wealth through emotional decision-making. The market didn't cause their permanent loss. They caused it themselves. The method to avoid this is psychological preparation. You need to understand before you invest that declines will happen. Not might happen, will happen. Over a 30 or 40-year investing career, you will experience multiple bear markets where the value of your portfolio drops 20, 30, even 50%. That's part of how markets work. It's the price you pay for the long-term returns that stocks provide. If you can't tolerate that volatility, if seeing your balance drop 30% is going to cause you to panic and sell, then you need a more conservative allocation. Maybe 60% stocks and 40% bonds instead of 90% stocks. You'll give up some return, but you won't destroy yourself by selling at the bottom. This is why knowing yourself matters. Some people can watch their account drop 40% and just shrug and keep investing. They understand it's temporary. They trust it'll recover. They might even see it as an opportunity to buy cheaper. Other people lose sleep over a 10% decline. There's no right or wrong temperament, but you need to align your portfolio with yours. Let me tell you about what happened in March 2020 during the early pandemic panic. The market dropped about 35% in a few weeks. I got calls from people who were terrified. Some sold everything and went to cash. The market recovered fully within about 16 months and then went to new highs. The people who sold locked in huge losses and missed the entire recovery. Some of them still haven't gotten back into the market because they're waiting for the right time, which means they've now missed years of gains. Compare that to people who just held on or who kept investing through the decline. They're fine, better than fine actually, because they were buying shares at lower prices during the panic. The only difference was behavior. Both groups experienced the same market decline. One group turned it into a temporary dip, the other turned it into a permanent disaster. The fourth cause of permanent losses is excessive risk-taking, usually in pursuit of higher returns. This is where people put money into speculative investments they don't understand because they want to get rich quickly. Penny stocks, options, leverage, cryptocurrencies, whatever the hot thing of the moment is. They take a flyer with money they can't afford to lose, and when it doesn't work out, which it usually doesn't, they've suffered a permanent loss. I've seen this countless times. Someone in their 50s realizes they're behind on retirement savings. So they take their $300,000 and put $100,000 into some speculative investment, hoping to double it quickly. The investment goes south. They lose $50,000 or $75,000, and now they're even further behind. The desperation to catch up made their situation worse. The method to avoid this is recognizing that speculation is not investing. Investing is putting money into productive assets that generate cash flows where you can make a rational estimate of value. Speculation is betting on price movements, hoping someone will pay more than you did. There's a role for speculation if you understand what you're doing and you're using money you can afford to lose entirely. But it's not a method for building wealth, and it's not appropriate for money you need for important life goals. When you're behind on savings, the answer is not to take bigger risks. The answer is to save more, work longer, spend less, and invest conservatively. That's not fun. It's not exciting, but it works. Swinging for the fences with money you can't afford to lose usually just makes bad situations worse. I knew someone who put $50,000 into options trading because he watched some videos online that made it look easy. Within 6 months, he'd lost $40,000 of it. Options are leveraged, which means small moves in the underlying stock can wipe you out completely. He didn't understand what he was doing. He was just gambling, and he paid the price. That $40,000 is gone permanently. It's not coming back. Now, let me talk about what avoiding these permanent losses allows you to do, because that's the real point. If you can just not make these major mistakes, if you can avoid overpaying for assets, avoid excessive fees, avoid panic selling, avoid speculation, the compound growth over time is extraordinary. Let's say you start at age 30 with $20,000. You invested in low-cost index funds. You add $10,000 per year. You earn a reasonable 8% annually. You don't panic during downturns. You don't chase hot stocks. You don't pay high fees. You just steadily invest and compound for 35 years. At age 65, you have about $1,300,000. You didn't do anything brilliant. You didn't pick winning stocks. You didn't time the market. You just avoided permanent losses and let compound growth work. That's the power of not losing money. Now compare that to someone who makes a few major mistakes along the way. They panic and sell during a downturn. They're out of the market for 2 years. That costs them maybe $200,000 in lost growth. They keep money in high fee funds. That costs another $200,000 over their career. They put $50,000 into a speculative investment that goes to zero. These mistakes might seem unrelated, but they add up. That person ends up with maybe $700,000 instead of $1,300,000. They lost $600,000 not because they were unlucky, but because they violated the first rule repeatedly. This is why I say never losing money is the most crucial thing. Not because it means you'll always make money every year. Some years your portfolio will be down. That's fine. That's expected. What matters is avoiding the catastrophic permanent losses that set you back so far you can't recover. Let me address something that confuses people, which is the difference between nominal losses and real losses. A nominal loss is when your account balance goes down. A real loss is when your purchasing power goes down. They're not the same thing. If you have $100,000 in cash earning 1% and inflation's 3%, you haven't lost money nominally. Your balance is still going up slowly. But in real terms, you're losing 2% per year. After 10 years, your $100,000 is nominally worth about $110,000. But in purchasing power, it's only worth about $82,000 in today's dollars. That's a real loss of $18,000, even though the nominal balance went up. This is why being too conservative is its own form of losing money. If you're so scared of market volatility that you keep everything in cash or very conservative bonds, inflation will steadily erode your wealth. You're not experiencing nominal losses, so it feels safe, but you're suffering real losses every year. When I say never lose money, I mean in real terms. I mean preserve and grow your purchasing power over time. That requires taking some risk, accepting some volatility, owning assets that grow faster than inflation. For most people, that means stocks which are volatile, but which have historically provided real returns over long periods. There's also the question of opportunity cost. which is a form of losing money that people don't think about. Every dollar you spend is a dollar you're not investing. Every dollar you leave in a low return asset is a dollar that's not compounding at higher rates. These aren't losses in the traditional sense, but they're opportunities you're giving up. If you're in your 30s and you spend $5,000 on something you don't really need instead of investing it, you're not just out $5,000. You're giving up what that $5,000 would have grown to over the next 30 years. At 8%, that's about $50,000. The true cost of that purchase is $50,000 in future wealth. That's worth thinking about before you spend. The method to avoid these opportunity costs is being intentional about spending, not being miserly, not denying yourself everything, but being conscious of trade-offs. Every spending decision is a choice between consumption now and wealth later. Sometimes consumption now is worth it. Often it's not. Most people make these decisions on autopilot, and they pay for it with decades of lost compounding. I see people in their 20s and 30s spending money freely because they figure they have time to save later. They'll make more money as they get older. They'll catch up. But what they don't realize is that the dollars they invest in their 20s are worth 3 or 4 times as much at retirement as the dollars they invest in their 40s because of the extra compounding time. Delaying serious saving by 10 years can cost you hundreds of thousands in retirement wealth. Let me talk about one more dimension of never losing money, and that's protecting yourself from fraud and scams. This becomes more important as you accumulate wealth because you become a target. There are people and schemes designed to separate you from your money. And if you fall for one, that's a permanent loss. The way to avoid this is skepticism. If something sounds too good to be true, it is. If someone is promising guaranteed high returns with no risk, they're lying. If an investment opportunity requires you to act quickly without time to think or get advice, it's probably a scam. If you don't understand what you're investing in, don't invest in it. I've known wealthy people who lost significant amounts to Bernie Madoff or other fraudsters. These weren't stupid people. They were successful, sophisticated individuals who wanted to believe that someone had a special system for generating steady high returns. They ignored red flags because they wanted it to be true. And they lost everything they'd invested. The method to avoid this is simple. Stick to transparent, regulated investments, index funds, individual stocks of public companies, government bonds, real estate you can see and touch. Avoid private investments unless you really understand them and the people involved. Avoid anything that seems secretive or exclusive or that requires suspending normal skepticism. If you can't explain an investment in simple terms, you shouldn't own it. There's also the danger of affinity fraud, where scammers target people in specific communities, religious groups, ethnic communities, professional associations, country clubs. The scammer joins the community, builds trust, seems like one of them, and then pitches an investment opportunity. People let their guard down because the person seems trustworthy, like them, and then they lose everything. I knew someone who lost about $300,000 this way. A fellow member of their church ran a Ponzi scheme disguised as a real estate investment fund. He paid early investors with money from later investors, the classic structure. It worked for a few years. People got their promised returns. They told their friends more people invested. Then it collapsed. Most people lost everything. The scammer went to prison, but the money was gone. The lesson is that trust and verification are both important. Even if someone seems trustworthy, even if they're recommended by people you know, do your own due diligence. Understand what you're investing in. Make sure it's legitimate. Don't invest just because others are, because you trust the person. That's how people lose money permanently to fraud. Now, let me tie this back to the original point. Rule number 1 is never lose money. The method to follow that rule is avoiding the behaviors and decisions that cause permanent losses. Don't overpay for assets. Don't pay excessive fees. Don't panic and sell during downturns. Don't speculate with money you need. Don't fall for scams or fraud. And don't let inflation erode your wealth by being too conservative. This isn't complicated. These aren't sophisticated strategies that require expertise. They're basic principles that anyone can follow. But following them requires discipline, patience, and the ability to resist emotional urges and social pressure. That's the hard part. Most people know intellectually that they shouldn't panic and sell during downturns. But when the market has dropped 30% and everyone around them is panicking and the news is apocalyptic, they do it anyway. Most people know that high fees are bad, but their advisor seems smart and trustworthy, so they pay the fees anyway. Most people know that speculation is risky, but they see others making money. They don't want to miss out, so they do it anyway. The difference between people who build wealth and people who don't isn't intelligence or special knowledge. It's the ability to follow basic principles consistently over decades despite emotional pressure to do otherwise. It's the discipline to never lose money through avoidable mistakes. If you can do that, if you can just not screw up in major ways, compound growth will take care of the rest. You don't need to be brilliant. You don't need to find the next big stock. You don't need to time the market. You just need to avoid permanent losses, keep investing consistently, and let time do the work. Let me give you one more concrete example to make this real. Two people both start at age 35 with $50,000 saved. Person A follows the principles. Low-cost index funds, stays invested through downturns, adds $500 per month consistently. Person B makes mistakes, panics in 2008 and sells, misses 2 years of recovery. Keeps money in high-fee funds, paying 1.5%. Puts $20,000 into a speculative investment that goes to zero. At age 65, person A has about $800,000. Person B has about $450,000. Same starting point, same monthly contributions, but person B lost $350,000 to avoidable mistakes. That's the cost of violating the first rule. And person B probably doesn't even understand what happened. They think they were unlucky, that the market didn't work for them, that investing is rigged. But the truth is they destroyed their own wealth through behavior. Person A wasn't smarter or luckier. They just didn't lose money through stupid mistakes. That's the method. That's what never lose money really means. And that's why it's the most crucial rule in investing, not because it's complicated, but because violating it is so costly and so common. The people who succeed are the ones who take it seriously and structure their investing around avoiding permanent losses. The people who fail are the ones who thought it was too simple to matter or couldn't maintain the discipline to follow it. If you're investing for the long term, building wealth for retirement or for financial independence, this should be your primary focus. Not maximizing returns in any given year, not beating the market, not finding the hot stock, just avoiding the mistakes that cause permanent losses. Do that successfully for 30 or 40 years and you'll end up wealthy. Fail to do it and you'll wonder why you worked your whole life and have little to show for it. It really is that crucial. The beauty of this approach is that it's defensive. You're not trying to do something extraordinary. You're just trying not to do something stupid. And over long periods, not doing stupid things consistently beats trying to be brilliant inconsistently. That's the real secret to building wealth. Not brilliance, just avoiding permanent losses through discipline and patience. That's the method, and it works.